This Week in Economy, 11th of November 2019. From WBRN Radio and on Bostonred Network, this is the Numbers Man part of macroeconomics program, where we partner with Cranston Analytics. Nonetheless, this is an interesting week, as we usually say it is. It is in that we have productivity figures here, and we also have GDP, I believe, by states here also. So we'll look at some of those. The week ending, wait me just a second here, I have to get on the right workstation. The jobless claims fell more than expected. We had that to happen. So that's not unusual. I was looking at this headline in CNBC here as we move around, and we'll go to the Labor Department Bureau of Statistics here, and the productivity figures, we'll do theirs, and then we'll go and do the general roundup. This is CNBC, dropped the most since 2015. That would have been, 4 years ago? That would have been Q4 of 2015. American workers were unexpectedly less productive during Q3, with growth in their output falling to keep up with hours worked. This is from the Department of Labor here. Non-farm productivity, which measures hourly output per worker, fell 0.3 and annualized rate between July and September, the biggest decline in 4 years. Unit labor costs, the price of labor per single unit of output, rose at a rate of 3.6% in Q3. Some of the takeaways here. American workers were unexpectedly less productive during the third quarter. Non-farm productivity fell. We just gave that here. They're reiterating. We were just getting the takeaways. The decline, according to CNBC, was set back prospects of a pickup expected by some economists, in the trend drove for productivity following the 2017 tax law. These tax laws usually don't change things, partially aimed at fostering investment. They rarely bring about any investment. Analysts had expected productivity to grow at 0.9%. Part of the surplus owed to a modest upward revision in the Labor Department's estimate for productive growth during the Q2. That was at 2.5% growth from a previous estimate of 2.3% growth. With the revisions, labor productivity was 1.4% higher in Q3 than the same period in 2018. This is a tenth of a point more than 3/10 average growth rate, and this is 2007 through 2008, but well below the 2.1 long run average between 1947 and 2018. The labor productivity also declined in the factory sector, and for the second straight quarter at 0.1% annual rate in the third quarter. Labor costs, the price of labor per unit output rose at, again, 3.6%. Hourly work rose at 2.4% there. And while we're here, the market, the market's at is above 2,700. Let's just jump over here. We have a lot of this is productivity costs. It was out on the 6th of November. It was embargoed. This is from the Bureau of Labor Statistics, and reported today a decrease of 0.3% in Q3, an output increase of 2.1%, and hourly work increased by 2.4%. All quarter percentage change in this release. They were seasonally adjusted. Productivity increased at 1.4%, reflecting a 2.3% increase in output and 0.9% in hourly work. Labor productivity, or output per hour, is calculated by dividing the index of real output by an index of hours worked for all persons, including employees, proprietors, and unpaid family workers. So it's a much broader interpretation here. The unit labor cost, this is non-farm businesses, and we talked about this before. I'm a little bit frustrated by this non-farm. Farms don't play very much in. Anyway, nonetheless, that's a holdover from Depression times and the 50s. Anyway, 0.3% in Q3, reflecting a 3.3% increase in compensation per hour, and a 0.3% decline in productivity. Unit labor costs increased by 3.1 over the last 4 quarters. And the Bureau of Labor Statistics calculate labor costs at the ratio of hourly compensation to labor productivity. An increase in hourly compensation tends to increase labor costs, and increase in output per hour tend to reduce hourly work. Data for non-farm business labor production measures, including hours worked for all persons working in the sector, wage and salary workers, self-employed, unpaid family workers. A quarterly change in hours worked by self-employed and unpaid family workers are the most volatile for wage and salary workers in Q3 of 2017. Self-employed workers made an unusually large contribution to the growth in hours worked by all persons. Now we'll get to this. Manufacturing sector labor productivity declined 0.1% in Q3 of 2019 as output increased at 1.1 there, and hours worked increased at 1.3. Total manufacturing sector productivity declined 0.1 over the last 4 quarters. Output decreased by 0.5, and hourly work decreased by 0.4. Productivity increased 1.2 in doable manufacturing sector in Q3, reflecting a 2.4% increase in output and a 1.2% in hourly work. Productivity decreased at 1.5 in non-durable goods manufacturing sector, and declined 0.2%. Hourly work increased at 1.3, and unit labor costs for manufacturing sector increased at 3.6% in Q3, an increase of 4.9% from the same quarter a year ago. The concept, source, and methods used for manufacturing output series differ from those used in business and non-farm output series. Okay. Revised in previous measures in the second quarter 2019, non-business sector activity increased at 2.5%, slightly more than reported on the 5th of September. Unit labor costs increased at 2.4% during the Q2, slightly less than the previously reported. In manufacturing sector, productivity was revised down 0.2% to a decrease of 2.4%. Durable goods manufacturing productivity decreased by 0.8%, and non-durable goods manufacturing fell 4.3%. After revisions, unit costs in total manufacturing increased by 6.9 in Q2 of this year, 6.7 as reported on the 5th. So revisions there. Second quarter measurement of productivity and costs were revised. Non-financial corporation sector productivity increased at 2.5% rather than at 2.8% as previously reported. Unit labor costs increased at 2.5%. And we look at some of these. This is preliminary third quarter here. I think we covered. We won't be any more repetitious here than we need. Anyway, let's move along here. Gross domestic product by states. This is second quarter of 2019. Texas had the fastest growth in Q2. Real domestic product, GDP, increased in all 50 states. and the District of Columbia in the second quarter of 2019, according to statistics released by the Bureau of Economic Analysis. Percentage change in real GDP in second quarter ranged from 4.7% in Texas to 0.5% in Hawaii. And we'll just look at some of these and see where they are. In Washington State, let's see, real GDP by state, 3.2 in Washington State. Oregon, it was 2. California, 1.9. Idaho, 2.4. Montana, 2.5. Nevada, 2.6. Utah, 3% there. Wyoming, 4.2. Arizona, 2.9. New Mexico, 4.1. It came in a little higher there. Colorado, let's see, 2. Texas, 4.7 there. Oklahoma, 2.7. Kansas, 2.2. And you see where this is going. Nebraska, 2.4. And the energy states, North and South Dakota at South Dakota at 1.7 and North Dakota at 1.8. Iowa, one of the big political states, at 1.1. Wisconsin at 1.1. Illinois at 1.1. Boy, the Midwest is hurting. And Michigan at 1.1. And Indiana at 1.1. Ohio at 1.3. Kentucky at 1. Minnesota at 2. Tennessee at 1.3. Arkansas at 1.8. Louisiana at 1.7. Mississippi, the better of the South, at 2.3. Alabama at 1.8. Georgia at 1.1. And South Carolina at 1.8. And North Carolina at 1.6. Florida was at 2. And if we go to West Virginia, they were 1.7. Virginia, 1.9. Pennsylvania, 1.7. New York State also 1.7. Vermont at 1.3. New Hampshire, 1.3. And Maine at just 0.6. And let's see, the Commonwealth of Massachusetts at 1.5. Not much growth in the Northeast Iowa. Just looking at some of these growth figures by, this was in Q2. We don't. Now, Texas, Wyoming, Alaska, and New Mexico, the fastest growing states. We didn't get, for some reason, why did we not get Alaska? It was probably, it was 4.1. We didn't get it because it wasn't there to get. Anyway, professional, scientific, and technical services increased 7.4 for the nation, contributed growth in all 50 states and the District of Columbia. Government increased at 3.1 for the nation and contributed growth to all 50 states and the District of Columbia. Real estate and rental leasing increased by 2.6 for the nation, contributed in 49 states and the District of Columbia. Wholesale decreased by 2.7 for the nation, subtracting from growth in all 50 states and District of Columbia. Wholesale trade was a leading contributor to slow growth in Hawaii, Maine, and New Jersey. Today's release includes the results of economic analysis, annual update, GDP by state, these annual estimates here from Q1, Q2 were revised. Well, we do have some things here. For example, in the U.S., GDP was at 2.9 in 2018, and 2003 in the first quarter was 3.1, and in Q2 it was 2% GDP. And looking at some of the states, if we look at New England, in 2018 it was 2.2. In the in the third quarter of 2000, this is just for New England, it was 2.4. And it's first quarter in the New England 3.1. It was 2% in the second quarter of 2019. The Midwest in 2018 it was 1.8. This is a region there. And in the second quarter in the Midwest was 2.7, 2.2. This is in 2018, and a negative -1. It was it was 4% in the first quarter of 2019 and 1.5. Down she goes. That was in the Midwest. So when you start looking at some of these states, if we go to the Great Lakes region, 2.2 in 2018 and 1.1 in Q2 of 2019. and that is Illinois, Indiana, Michigan, Ohio, and Wisconsin. The Plain states of Iowa, Kansas, Missouri, Nebraska, North and South Dakota, they were 2.3 in the first quarter of 2018, and they're now at 1.9. In the Southeast, 2.2 in Q1 of 2018, and 1.7 around. That's Alabama, Arkansas, Florida, Georgia, Kentucky, Louisiana, Mississippi, North and South Carolina, Tennessee, and Virginia. And we go down to the Southwest, a little confusing here. Arizona, New Mexico, Oklahoma, in that they were 3.9. Very good growth in Q1, and they actually ended at 4.3 this time around. The Rocky Mountains, that's Colorado, Idaho, Montana, Utah, and Wyoming, 3.3. And they were at 2.9, but that's a little bit different there. Utah was flying higher. And the far west, that's Alaska, California, Hawaii, Nevada, Oregon, and Washington, they were 4.3. That was in Q1 of 2018, and this time around they were at 2.1 in Q2 of 2000. Okay. That is that, and let's see here. We've already got the productivity part. We'll get back and do some of these markets. We'll go to some of the market purchasing managers index. PMIs are here. We'll start with China. This is out on the 5th of November. We might have got this before. Anyway, this is a composite PMI, which covers manufacturing and services. A modest increase in business activities in October. It was at 52, and the composite index edged up to 51.9. Not bad at all there. This is from the Shenzhen index here. Manufacturing service companies in China recorded a further increase in new work at the start of Q1, while the ratio of goods producers was the steepest since January of 2013. Price expansion softened across the service sector. Notably, service sector saw a modest upturn in new business. Overall, the rate of composite growth was a solid and unchanged from September, 19 months high. The key points here: solid manufacturing output growth, a contrast with only marginal rise in service activity. Composite employment fell for the first time in 3 months, and outstanding business at the composite level increased at its quickest rate. And let's see what else. These are comments here from Dr. Zahn. Anyway, the index dropped to 51.1 in October from 50.3 temps in September, making the slowest expansion in 8 months and subdued market conditions. Alright, we'll just fly along here. This is from ISH Market with the Russian business outlook. Output expectation improved since June. Hiring intention strongest for a year, and investment predictions highest since February of 2012. According to the latest data from the Russian Business Outlook survey, private sector firms are slightly more optimistic regarding business activity over the coming year. The net balance of companies' expected increase in output has been seen at plus 15% in June to plus 20% in October. Firms are anticipating a rise in business activity, linking this to new product development, investment in new machinery. Okay. Some companies are more optimistic due to greater opportunities to expand their export markets and plan for broader sale activity. Needlessly, the net balance is below the long-running trend since late 2009. That would be the end of the Depression. Threats to expansion during the next 12 months include greater administrative requirements, increased bureaucracy, higher operating costs, input costs, intensive and more intense competition, Companies also report concerns about client demand and global economic conditions. Manufacturing service providers alike are more confident of a rise in output during the next 12 months. Employment investment here, well, hiring expectations improved from June, recent low, and net balance here. In October, it's plus 17%, the highest for the year, although firms express concerns surrounding shortage of skilled workers. This is in most of the industrial economy. Both manufacturing and service providers are more optimistic about increase in workforce numbers next year. Private sector companies also predict growth in investment over the coming months. The net balance of firms foresee an increase in capital spending. That's 12% there, plus 12%. Private firms in Russia foresee both staff and non-staff costs increasing over the next 12 months. That's next year. Portion of company forecasting a rise since June. The net balance expects an increase. Okay. Corporate earnings and balance of firms predicting greater profits over the next year. 14% is slightly higher than the 12% in June. And from Mr. Jones here, Cyan Jones, Russian private sector firms have revised up their expectations toward business activity over the next year. In October, forecasts are still historically subdued, however, and net balance of firms there. Vets say companies are much more upbeat regarding investment and hiring for the next 12 months. Confidence towards future employment is at its highest for a year. That's kind of interesting here. I suppose that mirrors the emerging markets. And finally, private sector companies expect price pressures to intensify over the next year. That's 2020, with predictions for staff and non-staff costs being revised up. Needless, the optimism towards selling prices rise and probability have improved. That's interesting. Okay. Let's move from the Russian Federation to where would we go next? Okay, India. Very large economy here, very large country. Downward revision to output, proper employment expectation. Koplik's plans crisis. Companies turn pessimistic about investment on research and development. Muted non-staff costs, inflation forecast. Business conditions. This is for the month of October. Business confidence amongst private sector companies in India is down in October, with sentiments towards output, probability, and capital spending at their lowest level since comparable data available. That was in late 2009. That was in the Depression. Concurrent firms foresee broadly muted staff cost inflation and have revised down their projections for selling changes accordingly. Okay. Survey participants cite several threats to the outlook, including regulations, fierce competition, non-responsive demand, subdued global conditions, that's probably more than anything else, and unfavorable exchange rates, infrastructure issues, automobile sector weakness, and environmental concerns. They've had a lot of smog in Delhi, air pollution, in other words. Where expansion is anticipated, companies hope for better demand conditions, currency stability, and a more favorable market scenario. Restricted pricing power anticipated, subdued conditions, relatively muted input cost inflation on only a net balance of plus 8% of private sector companies plan to lift their selling prices in the year. I guess a little deflation there. Inflation expectations for non-staff costs are the lowest in the world. While service companies forecast a marginal rise in operating expense, overall projections amongst good producing producers are neutral. Divergent sectors trends are noted for staff costs, with a downward revision there. Probability growth is set to soft And that's been coming out of India for quite a while now. The commentaries here is Pollyann DeLummer, principal economist at ISH Market. The trend of diminishing sentiment among Indian companies contrasts with improvements across other developing countries, but matches that seen elsewhere globally. Concerned over weak domestic and international demand have weighted heavily on the confidence surrounding business activity, in turn curtailing spending plans. Disappointing to see almost across the board deterioration in sentiment levels, with a net balance of staff costs the only one that's rising since mid-year. Most worries are the downward revisions to spending plans for capital employment as well as anticipated R&D. If you don't have R&D, you're in trouble to begin with, period. On the employment front, a net balance of 7% of firms foresee job creation. This is the lowest figure in over 2.5 years, but match the global average. And we keep referring here from Russia to India, global situation. Employment projections have weakened in both manufacturing and service sector. The CAPEX is predicted to expand. The aggregate level of confidence is down to its lowest level since comparable data become available. So not very good situation there. Let's move on from India. India does not have very much to offer. Japan, business outlook, business confidence weakens again in October. And business outlook in Japan is the least optimistic for over 3 years. Subdued output forecasts appearing across both manufacturing and services. According to the latest survey, Japan's private sector companies are the least optimistic towards activity for the next 12 months in over 3 years. Moreover, the level of optimism is weaker than the global average, having erased a 4 consecutive survey period. In October, subdued expectations also appeared at that sector, with manufacturing and service providers reporting modest growth projections. Anticipated activity increases at only 10%. This was down slightly from 11%, not very much there. Although the survey highlights subdued prospects for the year ahead, anecdotal evidence highlighted where firms are identifying growth opportunities over the 12 months. Firms foresee new product launches as a key driver of new business. This happens many times in downturns. New businesses appear, while other firms are optimistic that the Japanese economy will pick up to approaching the Tokyo Olympics. They say political tension with Korea, the U.S.-China trade war, and of course they have an aging population. Aging population plays more into it than other things would. And according to some companies, while others indicate that raw materials, tariffs, and energy costs will ramp up pressure on profit margins. In response, businesses plan to raise their output prices in order to pass on part of the higher cost burdens towards clients. However, the latest survey data indicates that selling change inflation is set to soften in the next 2 years. Corporate earnings, following on from a negative probability expectation in the previous survey, October data shows that firms anticipate marginal growth in corporate earnings over the next year. The aggregate number of mass diverging trends at the sector level, with expectation of profit growth in the service economy in contrast with forecast reduction in manufacturing. This is the same trend you see in the U.S. too. The Japanese economy has showcased its ability to continue growing this year despite strong headwinds. This is from Joe Hayes, incidentally, an economist at ISH. The Business Outlook survey shows that firms continue to expect activity levels to grow over the next 12 months amidst opportunities arising from the Olympics and develop of new products, especially in the automobile and electronics sector. That's going to be very interesting in a world economy that's basically cooling. Notably, the overall feelings amongst panelists seem to be relatively downbeat, with the U.S.-China trade war and concern over spillover into the domestic economy, undermining business sentiment as has been the case in much of 2019. So that is Japan. And we'll roll right on here. This is the U.S. Service U.S. sector PMI, fastest contraction in healthcare business activity since August of 2016. That's the key point. Consumer goods production growth accelerates to 8-month high, slowing only a fractional rise in consumer service activity. The service U.S. sector, PMI, are compiled for response to questionnaires. Anyway, healthcare noted the fastest contraction in business activity. Although the decrease was only modest overall, it was the first decline since March of 2017. Industries and technology firms noted a quicker increase in output. The upturn in the former was only marginal overall, despite acceleration to a 3-month high. Business activity amongst tech firms rose modestly and at similar rates as seen in September. Consumer services firms indicated the slowest pace of growth in the current 5-month sequence expansion. Basic materials and financial companies registered soft upturns also. See what else we can drum out. Oh, I guess this is country here. Hoping our pointer points out. This is China, the business outlook there. We actually reported on China, but this is a little different date. This is the 11th of November. Just came out here. The latest business outlook survey indicates Chinese companies remain relatively cautious with regard to next year, 12 months. A net balance of 14% of firms anticipate output to increase over next year, which is up only slightly from the June's record low of 9%. That said, the latest figures is in line with global average. We keep referring back to global average. Sector data shows that a slight uptick in optimism is due to strong confidence in the manufacturing sector as expectations weaken across the service sector. A little different there. Other factors are weighing the ongoing trade dispute there, increased in raw materials, very important, tougher market competition. Corporate earnings following stagnant profit projections in June. Chinese firms are forecasting improved profitability over the next year. However, the net balance of firms predicting an increase in corporate earnings is only a plus 5%, with both goods producers and service expressing relatively subdued levels of optimism. Annabelle Fiddles here is a principal economist. Market among Chinese companies, there's a little more confidence than in June. The latest business outlook data show that optimism regarding the year ahead remains close to a record low in October. Positive forecasts are widely attributed to supportive state policies, new product innovations. We saw that hopefully in Japan. Expectation of firmer demand conditions. However, projections of rising costs, the ongoing trade dispute, certain sectors remain heavily weighted. And to finish this up, as a result, companies anticipate a relatively modest rise in output over the next 12 months, while job creation forecast is only marginal. There's also signs of a greater squeeze on profit margins over the year ahead. China is not alone with concern over the outlook, with business confidence globally at its lowest level in the survey's history and increasing market uncertainty. So this comes from China. Employment investment plans. Employment growth across China is forecast to be relatively weak over the next year. A balance of 4+ firms, percentage plus firms, expect to increase their staff numbers up slightly from the all-time low of just 1%. Service companies are marginally more upbeat about future job creations than manufacturing. So basically you see low downturns there, in line with the trend for employment. Capital investment intentions are picked up slightly from June's low, but remain historically subdued. operating expense faced by Chinese companies are forecast to increase over the next 12 months. Panel members anticipate staff and non-staff costs to rise simultaneously. Both count manufacturing anticipate faster rates of inflation than their service sector counterparts, despite expectations of rising input costs. Competition, business. Okay. So we have more competition, fewer workers available. Very interesting thing. But that's in all industrial nations. Their U.S. business outlook, weaker business confidence across manufacturing service sector. Employment forecast is lowest since February of 2016. Inflation expectation moderates, results in more subdued profit predictions. Again, this is their business outlook. U.S. Private sector firms are less optimistic towards the outlook for business activity over the next 12 months. The net balance of firms expect rise in output has dropped from plus 16% in June to 10% in October, a 6% drop. The balance of firms forecast growth below globally 14% and developed market 12%. Confidence is generally linked to new export opportunities, with some companies planning on expanding ongoing. At the same time, some private firms are suggesting that they have attracted new clients as more customers switch to domestically produced goods. Companies also predicting that the greater market activity and release of new products there. That said, several key factors are expected to weigh on growth. It highlights again, tariffs come up here, higher operating costs perhaps more so than the tariffs. But anyway, manufacturing and service sectors both expect to raise their selling prices going up. Corporate earnings are notably lower than those seen a year ago. Net balance companies expect a rise in their profits at 8%, having fallen steadily over the course of 2019 from a plus 31. Syed Jones, an economist, said private sector firms in the U.S. expressing a more cautious level of optimism towards the overall year. In October, global trade tensions, an upcoming election, tight labor markets weighed heavily on business confidence, reflecting weaker forecasts for overall activity. Firms are less optimistic regarding future job creation, and many noting that a shortage of skilled workers. We see that same thing is in many countries, and moreover, inflation expectation. And private sector companies remain subdued, with smaller proportion predicting increase in cost burden and selling prices. A very strange situation. Manufacturing service revised down their expectation regarding future rise in both staff and non-staff costs as inflation expectation, despite ongoing reports of higher operating costs. Employment and investment, alongside weak demand, weakened degree of optimism, output of net balance of U.S. Private sector firms who forecast a rise in hiring next year has slipped to its lowest since 2016, a plus 5%. The reduced proportion of firms predicting an increase in employment is due to difficulty in finding against skilled workers, tighter labor market. This is the flip side of low employment rates, because what happens is if you have low employment rates, you probably employed most of the employable people out there, particularly the skills they're already working, with the exception of a record number of pharmacists, evidently in the U.S. I was reading, being made redundant or laid off. Pharmacy is not one of the bright new worlds there. A number of things happening there. A lot of drugs are dispensed by mail, automation, etc. And this is the global business outlook. This is where we'll end this up. Worldwide business optimism for the future. Output, employment, and profits hit its lowest since 2009. That's the depression. Inflation expectation hit its lowest in 3 years. Gloom spread from manufacturing to services. The four largest developed economies all report gloomy outlooks, led by a bleaker U.S. and Eurozone. I missed the Eurozone. It doesn't matter. Brighter manufacturing outlook lifted emerging markets, led by China, but prospects are still subdued. Worldwide optimism for growth in business activity, employment, and profits are the lowest since what they call the financial crisis, what we call the depression. Inflation expectations also weakened to a 3-year low. The October Global Business Outlook from ISH, based on responses from a panel of 12,000 companies, is conducted 3 times a year. The decline is down to 14% from 18% in June. This is predicting output rise above the coming year, minus those predicting a decline is down. Optimism peaked in early 2018 and has fallen steadily since to reach its lowest point since data was first collected during the Depression. Now, there's a noticeable divergency between the developed and emerging markets. While the developed world companies report bleak outlooks for growth since the Depression 2009, sentiment is higher in emerging markets, albeit remain close to global financial crisis. Developed world optimism has survey low. The developed world sentiment about future output is down to new survey low in both manufacturing and service. Sentiment about outlook has deteriorated in 4 of the largest developed countries, dropping especially sharp in the Eurozone, U.S. to 7 and a 3-year low respectively. Only slight fall in sentiment has been seen in the UK and Japan, but all these economies are on the ropes. Companies in the 4 largest developed economies report slow expectation selling price inflation over the coming year, but the trends are more mixed in emerging markets. High expectation inflation in China, Brazil, and Russia contrasts with a reduction in selling price inflation forecast to a new survey low in India. India had at one time been a promising market, but now it is in the colloquial basket case, with pollution so bad there they had to limit traffic in Delhi. Global trade tensions, an upcoming election. This is we already went through this before. Both manufacturing and service sector expressed a low level of positive sentiment towards the future outcome early next year. Employment and profitability in the U.S. have fallen since February 2016. The Eurozone, I will get it here anyway. Growth expectation in the Eurozone has slumped markedly to its lowest level in 7 years. Markedly to next balance, sliding from plus 27 in June down to just plus 12. Profits, meanwhile, anticipated to fall for the first time since 2012, with the Eurozone's gloomiest picture coming from Germany, the Hans people, where the number of companies expecting output to fall in the coming year have exceeded those expecting an increase. In manufacturing, especially downbeat, those sentiments have worsened markedly in Germany's service sector. Optimism, meanwhile, has deteriorated to 7-year lows in Italy and in Spain, and to its lowest for just over 4 years in France. It doesn't look good at all. UK business confidence is second lowest recorded in the past decade, with net balance expected output dropping to 31%. Manufacturing output expectation has deteriorated to its darkest in 8 years. Dr. Chris Williamson summing this up. Business around the world has become more gloomy about their prospects, with expectation for output and profits in the year ahead dropping to its lowest level since the Depression, global financial crisis 10 years ago. Sentiment has worsened continuously since the peak in 2018. Early 2018, with the latest survey showing a further erosion of confidence. The trade wars, tensions widen, geopolitical uncertainty, and worries about slowing economic growth or recession. Well, this is, The Outlook survey provides an early indication of a 2018 growth slowdown And the latest reading warned that manufacturing led weakening has spread further in the service sector of the world's major economies, and Dr. Williamson includes the U.S., Eurozone, China, and Japan, with business investment intentions and hiring trends expected to also deteriorate as a consequence of a broadening growth slowdown. The outlook data paints an increasingly gloomy picture that corresponds with our forecast for the global economic growth slowing to 2.5% in 2020. And that 2.5% is rather optimistic from this by Mike as we look at it. When you look at economic growth, especially in the types of economies you're in, is down. Let me just do the numbers here. The Nikkei was down negative 60.03. In Shanghai, they were down negative 54.21. The HIS, the Hang Seng, was down a negative, let's see here, 761.62. 200 is down, at a plus 48.40, and the Kopsi, that's in the Republic of Korea, is down a negative 13.14 there. And let's see, this is from CNBC, incidentally, and we'll go to the BBC in a second here. Ferry out the BBC. The market data from the BBC now. This is on the 11th, so okay, it's delayed by 15 minutes. Nonetheless, the FTSE was down 0.64. That's the FTSE 100, all in red there. The AX in Amsterdam was down 0.10% there, and in Paris they were down 0.2% there. The DAC also down negative 0.46 there, about a half point anyway in Frankfurt. And in the Euro Stasi, 0.19% in the negative there. And in Madrid, they were also down 0.57% there. And let's go to Asia and see what we didn't get in Asia. In Bombay, also down 0.11 in the negative. Hang Seng was down 2.26 in the negative there. And the Nikkei, I think we gave that one before, 0.24 in the negative there. Now back to the Dow. That was on a Friday. They were actually at 0.2% is what they put in. And the Nasdaq at 0.48% there, and the S&P was at 0.26. The Dow was at 27,681. That was right in Nasdaq at 8475. For those number aficionados out there. Commodities, Brent crude futures down and at $61.93. That's a change of 58 cents it lost. West Texas crude was also down 0.87%, or at $57.74. It was down 50 cents. T. Boone Pickens' ancestors are jumping for joy. Gold was also down. Very unusual day there at negative 1.16%, or $17.25 on the Forex. That's at $1,466.85. The Forex futures there. So that is our market, as they say. Everybody was basically down. Nobody was up. So that will do it for us. Wrap up here. Well, the global economy for Q4 is not that optimistic. For 2020, down. Will that change? I guess that's the big question we ask. Will that change if there's a China deal? Well, the situation there is the China deal will affect some products, but you can also, there are, as what's happened in the U.S., some of the products that were made in other countries, China, are now made in the U.S. and made in Vietnam. They have moved on. That will probably never be duplicated in the near future. And also you have, say for instance, pork is one of the commodities. China has the pork markets devastated by the African swine flu, so they're buying pork from whatever companies want to sell pork to them. They will buy pork, but it's commodity by commodity. And with the tariffs by the Trump administration, it's supposed to the latest round not go into effect until after the holiday Santa Claus rally there. We'll see how that works out. But people are anticipating, and this is where we tell the consumer to keep the eye on the ball, prices going up next year. And that will be not only at the tariffs of the trade, but other raw materials. There's a whole variety of things happening. Less manufacturing output out of Germany. The automobile market making its transition from carbon fuels or combustible fuels to non-fossil fuels. Fewer people driving automobiles, specifically in the West. And we're looking to see what happens with the mortgage rates are going up a little bit in spite of the Fed's cutting of the rate. Where does all that fit in? Well, it's interesting. When you get a weak economy, structurally weak, the last depression was caused by a total financial meltdown. But what we're seeing now is more demographics and structural changes. That's what's happening with pharmacists. One of the big pharmacists went out of the business in the upper Midwest state of Minnesota. Which one was that? Anyway, I think Health Partners. And they're laying off pharmacists, and of course within the upper Midwest area, there are not any openings for pharmacists because they have now paraprofessionals there, and they're getting into robotics and the centralization of these mail-order pharmaceuticals. So you're going to start seeing industries like that have been around for a very long time that will start gradually making redundancies. Self-checking out at supermarkets, consolidation of the grocery business, all those things play in there. And also one of the largest mining firms out of Ohio, I forget the guy's name, has emphysema, but anyway, he is in bankruptcy, and his company will be reorganized because of the win by natural gas over coal. So some of these things you cannot prop them up, no matter what the Trump administration tried to do for coal, it just didn't work out. Now for manufacturing is always a tenuous part of any economy because it's basically on supply and demand. And if demand goes down, supply used to go up, but now attention to inventories a different wicked picket. So so how does this explain in places like Ghana and some of the emerging markets doing much better? Probably they have their cost structure is less, and what they have to worry about is raw materials, and that will start to change as they get hands on raw materials and get more manufacturing in places like Kenya, Nigeria, etc. Right now they're just basically set up, particularly Nigeria, to send the oil out of Nigeria. They don't have the refining capacities there. And we also, I guess we didn't mention this, the IPO by the Saudi oil monopoly. It will come. They don't say how much there, but they expect it to be the largest IPO out there with their oil monopoly. But they are diversifying also, so it's a wild, wild west. This will do it for us, for those in business. Make this week a productive one. And for the consumer, obviously the eye is on the prize. We'll be interested in looking at the shopping numbers. I was out at one of the retail stores. It didn't have very many people in it. But again, as we move closer to Turkey Day, you'll see more on the Black Friday. But we'll be looking at those very, very closely. And even consolidation in the streaming business. Now Disney and some of those people have taken their movies in-house. How does this affect Netflix and some of those companies? How are some of the rules going to affect Facebook, Twitter, etc.?